Okay. It is Tuesday, January 20, 2026. If you're looking at your terminal right now, you're seeing Bitcoin just pinned. It's in a super tight range between, what, $91,000 and $92,000?
Yep. U.S. markets were closed yesterday for Martin Luther King Jr. Day. So you've got low volume, a flat chart.
It's like nothing is happening.
Which, as you know, in this industry, is usually when the most dangerous things are happening behind the scenes.
Right, because if you look away from the price for a second and actually look at the infrastructure, I mean, the actual rails this whole thing runs on, the last 24 hours have been, well, chaotic.
It's a complete paradox. We're calling this the tale of two markets.
That's a good way to put it.
Because on one side, you've got the decentralized finance world facing just catastrophic failures. I mean, pricing glitches, retroactive blockchain rollbacks.
It's messy.
It's very messy. And on the other side, you have a sovereign nation, Bermuda, announcing they're moving their entire economy on-chain.
It's a huge contrast. The toy version of crypto is breaking, while the institutional real-world version seems to be cementing itself.
Exactly. So our mission for this deep dive is to parse that signal from the noise. We need to explain how a decentralized exchange can suddenly decide Bitcoin is worth $0.
And at the same time, why a trade war over Greenland, of all places, is currently putting a cap on your portfolio.
And we are going to look at the facts here neutrally. The market doesn't care about politics.
It only cares about liquidity.
Liquidity is the only voter that matters.
Okay, so let's start with the wreckage. We have to talk about Paradex.
Oh, yeah.
For anyone who doesn't know, it's a decentralized perpetuals exchange built on StarkNet,
which is a layer 2 for Ethereum. And yesterday, they managed to price Bitcoin at 0.
0.00. How is that even possible?
It's the ultimate nightmare scenario for any automated system. So the mechanics of it were Paradex was doing a scheduled database migration, standard stuff.
Just maintenance.
Right. But during that window, their internal pricing oracle just flatlined.
And let's just clarify for everyone, an oracle isn't some mystical thing. It's just the data feed that tells the blockchain what the real-world price is.
It's the bridge. And that bridge collapsed. So the oracle fed a value of 0 into the whole system.
Oh, wow.
Now, Paradex has this automated risk engine. Its only job is to check your collateral and make sure you can cover your trades.
And it saw the price of Bitcoin as 0?
Exactly, which meant every single user who was holding a long position was instantly, technically, insolvent.
Because if the asset you're betting on is worthless, your collateral is gone.
The system did exactly what it was coded to do. It liquidated everyone, just wiped them out to protect the platform's insurance fund.
So people wake up, see Bitcoin at $92,000 in the real world, but their Paradex account says 0.
Total panic. Now, a bug is a bug. Bugs happen. But the cleanup, that's where this gets philosophically really messy.
They didn't just issue refunds, did they?
No, they effectively traveled back in time. This is the part that has the big institutional players very worried.
What do they do?
Paradex is a layer 2 rollup. The developers saw the error, they paused the chain, and they performed a hard intervention.
The name.
They rolled the entire blockchain back to block height, 1,604,710.
Which was timed right before the glitch happened.
Right, at 04.27 UTC. They just erased the timeline where the liquidations happened. Poof. Everyone's funds were restored.
Okay, let me play devil's advocate here for a second. If I lost my life savings because of their coding error, I'd want them to roll it back.
Yeah.
Isn't this just good customer service?
It is good customer service, but it's terrible for the premise of DeFi. The entire value proposition of this technology is supposed to be settlement finality.
The idea that once a transaction is confirmed, it's final. No one can reverse it.
Exactly. No CEO, no government, no developer. That's why we trust the code more than a bank. But Paradex just proved that they do have an admin key. They have an undo button.
So it's not code is law. It's more like code is law. Unless we mess up, then the law is whatever we say it is.
You got it. It just reveals that a lot of these layer 2s are still on training wheels. It's not like Bitcoin or Ethereum layer 1, where a rollback is basically impossible. These L2s are often centralized at the sequencer level.
And if you're a BlackRock, you look at this and you think,
if they can roll back a glitch, they can roll back my trade if a regulator calls them. It makes it look less like a protocol and more like a fancy SQL database.
and if that's all it is, why bother with all the complexity?
That is the $0 question, and it wasn't the only failure of trust yesterday. We also have to talk about Trove Markets.
Right. This one felt less like a tech glitch and more like a moral one.
A moral failure, yeah. Trove had their token generation event, their TGE.
And this is a classic case of what you'd call governance opacity.
Totally. So Trove originally raised money promising to launch on the Hyperliquid ecosystem, but then they pivoted to Solana, which, projects pivot, that's fine.
But that wasn't the problem.
No. The problem was they then announced they were retaining about $9.3 million of the money they raised for development.
So they just cut out the early investors from that capital,
Yeah.
locked them out of the liquidity.
And the market reacted violently. As soon as the token launched, it collapsed. 97% in minutes.
Wow. From 20 million down to what?
Under $600,000.
That's a wipeout. It's a soft rug pull.
It is. The team didn't just vanish, but they changed the rules so drastically that the value evaporated. Now you've got class action lawsuits brewing.
I saw that on-chain sleuths are tracking some of those funds moving to gambling addresses.
It just reinforces the worst stereotypes of the industry, and it creates this flight to quality. When you see stuff like this, it just makes the big money stick to Bitcoin and the regulated ETFs. The rest looks like a casino.
So the Wild West is on fire. But while all that was happening, the suit and tie version of crypto was making moves.
Big moves.
The government of Bermuda was at Davos, making a huge announcement.
This is the real signal here. Bermuda is partnering with Coinbase and Circle. Their goal is to become the world's first fully on-chain national economy.
Okay, that sounds like a great headline. But what does that actually mean? Are people going to be buying coffee with Bitcoin?
No, and that's a really crucial distinction. This isn't like El Salvador. They're migrating their tax system, government fees, merchant payments, all onto blockchain rails.
And what's the tech stack?
Specifically, they're using Base, which is Coinbase's layer 2, and USDC, the dollar-backed stablecoin from Circle.
Why do this? Is it just a PR stunt, or is there a real benefit?
Oh, there's a massive benefit. It solves a huge pain point on correspondent banking.
The middleman problem.
The middleman problem. If you're a bank in an island nation like Bermuda, you can't just plug into the global financial system. You have to go through a big bank in New York or London.
And those big banks see a small island nation as high risk.
Extremely high risk. So they either cut ties completely or they charge insane fees, and settlements take days. It strangles the economy.
So using USDC on Base is like building a bypass road around those banks.
It's a complete bypass. They can settle payments globally, 247 in seconds, for almost nothing.
But let's look at that stack again. They chose Base centralized and compliant. They chose USDC, a centralized, regulated stablecoin. They actively avoided the permissionless, decentralized tech that just blew up on Paradex.
That is the aha moment right there. We're seeing this great bifurcation. Bitcoin is solidifying its role as the reserve asset, digital gold, a place to store value.
But the actual economy, the medium of exchange?
That's being won by stablecoins on regulated rails. You're seeing the rise of a USDC block in the Caribbean. They're dollarizing, just digitally.
Okay, let's zoom out a bit. We've covered the plenty, the good, and the bad. But the macro weather is getting ugly, and that's hitting the price.
The trade war. It sounds almost ridiculous to say, but this Greenland dispute between the U.S. and Europe is escalating fast.
I think a lot of people just wrote that off as political noise.
It's not noise anymore. The Trump administration is threatening 10 to 25% tariffs on European nations. And the EU is treating this as a serious threat. Yesterday, the Eurogroup ministers met in Brussels.
And they talked about deploying the anti-coercion instrument, the ACI.
Yes. For anyone who doesn't follow trade law, just think of the ACI as the EU's economic nuclear option.
It lets them retaliate immediately, right? Without waiting for the WTO.
Exactly. Normally, they'd have to wait years for a ruling. The ACI lets them hit back with their own tariffs instantly. So we're moving from a slow, bureaucratic argument to a rapid-fire trade war.
And markets hate that kind of uncertainty. But wait, the standard crypto thesis is that chaos is good for Bitcoin. Shouldn't people be running to the digital lifeboat?
Eventually, maybe. But right now, the market is voting with its feet and it's running to gold. Gold is hitting all-time highs. Bitcoin is not.
So why the disconnect?
It's all about correlations.
Okay.
Right now, Bitcoin is trading like a high beta tech stock. It's glued to the NASDAQ.
So when the algos see trade war, they sell tech.
And they sell Bitcoin. Until it decouples from that risk-on behavior, these geopolitical tensions are a headwind, not a tailwind. The safe haven narrative just hasn't kicked in for this crisis yet.
Okay, let's get into some on-chain detective work. There's some spooky activity happening, specifically a whale that's been dormant since since the beginning.
Yeah, this was a big one. We tracked these vintage wallets, and yesterday, the address 1A2HQ woke up after 13 years.
13 years. So that's what, 2012, 2013? Bitcoin was basically free back then.
Practically. This wallet moved 909 Bitcoin. At today's prices, that's about $85 million.
So the big question, did they dump it? Did it go to an exchange?
No. And this is the interesting part. The forensic trail shows it was sent to a P2WPKH address.
Which is what?
It's just a modern SegWit address. It's a more efficient address format. The point is, if you were going to panic sell, you'd send it straight to Coinbase or Binance.
So this looks more like an upgrade.
It suggests they're updating their security. Maybe preparing for a private OTC deal or just securing the stash for another decade. But it still spooks the market when these ancient coins move.
Because if the people who bought it $10 are moving their chips around.
It makes the people who bought it $90,000 very nervous.
And speaking of nervous, there's a different kind of whale causing trouble on Hyperliquid, this 0xB37 entity.
Ah, the gambler, yes. This single trader is driving a huge amount of volatility. They're using a classic martingale strategy.
Which is where you double down every time you lose, right? Hoping one big win covered all your losses.
Exactly. And it works great until it doesn't. This entity just lost about $25 million, and instead of backing off, they've just increased their position size. Their open interest is massive.
So they are effectively holding the market hostage.
In a way, it creates this player versus player dynamic. The bears know this whale is over-leveraged, and they're likely trying to hunt their stop losses. Push the price down just enough to trigger a massive liquidation.
And if they blow up?
We could easily see a sharp wick down to 90,000, maybe even lower, just from that forced selling. It's why that $91,000 support level feels so fragile right now.
It's amazing that one person's risk tolerance can have that much impact.
That's the leverage trap.
Okay, quickly before we wrap up, Hong Kong. We have Bermuda opening the doors, but it seems like Hong Kong is trying to close them a bit.
Or at least make the door a lot narrower. Yeah, there's a dispute over the Type 9 licenses. The regulators want to get rid of the de minimis exemption.
That's the rule that let asset managers hold up to 10% crypto without a special license, right? It was a nice on-ramp.
Very nice on-ramp. It let traditional firms dip their toes in. Now the regulators want to say, if you hold even 1%, you need a full virtual asset license.
Which is a huge compliance burden.
Huge. And the industry groups are warning this will just choke off capital. Traditional wealth managers will just say it's not worth the hassle.
That probably explains why the Asian ETF flows have been so muted.
The plumbing is clogged with red tape.
Exactly. Okay, let's bring this all together. It really feels like we're at a significant crossroads this week.
I think we are. If you summarize the landscape, the technology layer is really struggling. Paradex, Trove, they show that DeFi is still prone to centralization and, frankly, bad actors.
But the adoption layer is maturing. Bermuda's proving that governments can use this technology to solve real economic problems.
As long as they use the regulated, centralized rails, and the price is just caught in the middle, stuck between a trade war and some over-leveraged whales.
So what are we watching for in the next 24 hours?
Two things. First, US ETF flows today. It's Tuesday, the holiday's over. Does the BlackRock bid come back in force? If we see outflows, that $90,000 level is in serious trouble.
And the second thing?
Keep an eye on the Mega ETH stress test. They're aiming for 11 billion transactions. We talked about rails breaking. Well, this is an attempt to build rails that can handle global volume. If they pull it off, it could really change the scalability narrative.
It's a constant battle between breaking things and building stronger things.
It always is. And I want to leave you with one final thought, just going back to that Paradex rollback.
Go for it.
We spend so much time talking about how crypto is building this new financial system, one that's supposed to be trustless and immutable. But if a so-called decentralized exchange can just hit pause and rewind the blockchain whenever they make a mistake and lose money, are we actually building a new system, or are we just building a slower, more expensive version of a database that banks already use?
That's the question, isn't it? The line between DeFi and CeFi just got a lot blurrier.
It certainly did.
Deep dive complete. Keep your eyes on the plumbing, not just the price. We'll see you tomorrow.